In trading, every little edge helps. So in this video, we're going to talk about pocket pivots. Pocket pivots are simply a way to identify the institution's footprints within a base or an uptrend in whatever stock or instrument you're looking at. Now, institutions, they generally buy within a consolidation period, and these pocket pivots can tip you off to when this is actually happening. So who really moves the markets? Well, you don't and I don't, but institutions, they do. And knowing when they're involved, that can really be an important piece of information for a trader. Like, do you really want to be involved in an instrument that doesn't really have big money behind it? Probably not. Now, pocket pivots, they're actually a potential buy point in a stock, and they're actually identified by a gentleman named Dr. Chris Katcher. So essentially, it occurs when a stock makes a high volume move up on a day when the volume is higher on that day than any of the down volume of the prior 10 days. And Katcher, he focused on companies that had strong fundamentals and generally are leading companies. So at the time that we find a pocket pivot, we want to see the stock in some sort of basing pattern and very little momentum. Now, basing patterns are usually thought of as areas to trade breakouts, but the pocket pivot will get you in before the break of a resistance zone when you're looking to go long. Now, for myself, trading breakouts, I have always been a proponent of trying to find an entry before the breakout. And that usually came in the form of a smaller range inside of the base, or when I saw price basing right under a resistance zone. You see that, and you get a reversal type of candlestick. Good to go. So getting in before the breakout, why is that a good thing? It's called front running. When you get into a move before the breakout, oftentimes you're going to have a better risk profile because you're entering somewhere around a support zone. So when that breakout occurs and you're already on board, you can see your position in profits and you're going to have space to adjust your stop to remove risk. But we can also see a pocket pivot that's viable after a breakout. Now, traders are going to look around the 10-period EMA for this pattern for a more objective approach when the pocket pivot's worth looking at. That's a continuation type of play. And when we have those, we want to see strong trend in strong stocks to find any sort of use with this. Now, a lot of people look for high volume on breakouts, but there are times that legitimate breakouts happen on low volume on the day of the breakout. And then over the next few days, what do we see? We see an increase in volume, and that validates the breakout is actually a success as price moves away. So how do we find these? There's a big group of stocks out there. So out of that entire universe, we only want to focus on those that have a strong fundamental backing. Now, Katcher, he recommended traders look at a stock with strong quarterly figures, good profit margins, a good ROE, which is return on equity and stuff like that. And when you use a screener like FinViz, that can help you find stocks that fit the fundamental characteristics that you like. You just use the drop-down boxes on FinViz and select the positive or very positive selections, and you can narrow down your list quite quickly. And if you want a quick and dirty method of finding these kind of stocks, you could also look at analyst ratings of stocks for buying suggestions. They're all over the internet. Next up, the volume indicator. So we are specifically looking for a day where the up volume is higher than any of the previous sell volume over the past 10 days. Now, there are also 5-day pivots, but when we get those, we want to see a clustering of those together. We then want to see if price is currently close to the 10-day moving average, because what we don't want to do is buy when price has extended too far away from an average price, because mean reversion is an actual thing in the market. So what's too far? That is subjective, but a closing price that's further than 8 to 10% away might be a little bit too extended. I generally look at 3 to 5% from the moving average. Above all, though, we want to see some type of chart formation that's a consolidation. You know, those V-type reversals that we get with pullbacks that have a pocket pivot in them. When we're looking at continuation plays especially, they have a tendency to be of a lower probability than a good basing pattern. So now we're going to have to use moving averages. So we're going to add the 50 and the 200 as well as that 10-day moving average. So we want to see price above the 200 and best case scenario above the 50 on all stocks that we're looking at. Now, if price is bouncing off the 200, well, that's also a viable location as long as we are seeing a basing structure. Also consider that if we're in a downtrend that's gone on for 5+ months, that's not where we want to trade these formations. Okay, we want to wait till we see the rounding out of that downtrend before we would consider trading it. So these examples I'm going to show you, they're going to have all the moving averages that we talked about. So for my scan, I also added a 50-day average volume of being greater than 200,000. Plus I'm looking at stocks that are greater than $5 and US only. So here, this stock had price whipping around the averages, and I used the condition of price breaking a downward trend line for confirmation. Price is within that 4% of that 10 SMA. Those green bars show the pocket pivot's location. Now that area near the arrow, that's a tightly congested price zone when you compare it to the left of the arrow. A trader would note the pocket pivot, and they would either enter there or look for weakness to get in. And weakness could be an inside bar, which is just a lower time frame consolidation, or a bull flag. And again, when we talk about pullbacks, as with any pullback, what we don't want to see is momentum against us during that corrective decline. Now, in the past, pocket pivots were designed to be bought on strength, but markets change, and so does the usage of these. Now we want to find a pocket pivot and then look to buy during any weakness that might appear after it. This daily chart is a great example of both the weakness play and the continuation of a strong trend. So we can see the tight consolidation in the middle as opposed to that sloppy price action on the left. Now we see price form a base right under resistance, and I told you, when I look at trading breakouts, I want to get in early, and this is my preferred condition. We see a pocket pivot form, then we get some weakness at that small black arrow. A trader can use a break of that high for a long entry. And then we see price take off to the upside, breaks a larger resistance zone. We see then price pull back, and it's a lazy pullback. There's no momentum against us, right to the 10 SMA zone. The next day, we get a pocket pivot and a buy point. Now, basing patterns, they can give us a few zones for our stops, and the obvious one is right under the entire basing pattern. It's a bit larger risk size, of course, but traders can also look to place their protective stop inside of the ranges. On the continuation play, the general stop location is under the low that's formed when price reverses. Now, what stop you choose, totally personal preference, and with some traders, they'll even use an ATR style of stop loss. Totally viable approach. Let's wrap it up. It's a simple volume price pattern, right? Pocket pivots, they can be helpful for any trader when you're looking to identify a potential entry in a strong stock. So when you look for stocks that are consolidating near resistance levels, traders can then find an early entry into the basing stock and to be involved prior to the actual breakout of price. When you use the 10 SMA, that can tell you if a stock is too far extended and could be ready for a pullback. So when we find pocket pivots around that 10-period average, it's an important piece of the volume pattern. Additionally, using the 50 and the 200-day moving average, we can get a sense of the trend and, depending on the price relationship to the averages, if too much weakness is set in when price is whipping around the averages. Finally, when we place our stop losses below recent lows or below the entire basing pattern, we get to protect ourselves from downside risk, which is just part of trading. I urge you to start looking through your charts, take a look at these patterns, find the basing patterns that really stand out to you, and start testing these going forward. Thanks for watching. Make sure you like and subscribe. We'll talk to you soon.